Let's talk about the impact of Trump tariffs on global uncertainty. We've discussed at our investment committee meetings that the full impact of tariffs are yet to be seen in many economies. Maybe, Jonathan, you could start with the US and what you're seeing in terms of how much impact and there has been from the tariffs that have come out, and when you expect to see the full impact of it.
Sure. Yes, Eugene, I think you're absolutely right. Every time we have these interviews, you always say that, as you just said, man, there's a lot that's been going on. I couldn't have said it better. Yeah, it's amazing, isn't it? We live in such an interesting time. I was saying to someone just the other day, I've been in the financial markets for 41 years, and I cannot recall a moment where there's so many fascinating things happening there. It's exhilarating, it's exciting, it's complicated, it's all of the above. And yeah, I mean, I still get excited waking up every morning to see what on earth has happened. But your specific question relates to tariffs, which of course have been very, very important for financial markets and indeed the global economy. But with reference to the impact on the United States, we now pretty much have a relatively good understanding of the total Trump tariff package. We all go back to that fateful day on April the 2nd, Liberation Day, when we were all shocked and horrified by the scale of the tariffs. And then, of course, we had the 90-day pause, and we've seen a lot of bilateral negotiation with some of the big powers. And now we've got a fairly good sense. I mean, obviously, the Indian tariff situation is still somewhat up in the air, with them being hit with 50% tariffs. The Chinese negotiations are still ongoing. One thing we will say very briefly, with respect to the US-China bilateral negotiation, that China clearly has a lot of cards up its sleeve. The primary ace up their sleeve is, of course, that China has so much of the world's processed rare earth materials and critical minerals, in particular magnets. And so, of course, the Americans have had to kind of be a little bit more softly in that negotiation. But talks are still ongoing, but that is a really big negotiation. But for the rest of the world, we pretty much know where we stand. So the average effective tariff rate as we speak is around the 18% mark. Now, that is up very, very substantially from the average effective tariff rate of approximately 2.4% that US had on imported goods at the end of 2024. So it's a material change. What does that mean? I've got a really rough and ready rule of thumb with regard to what is the impact of the increase on tariffs on US consumer price inflation over time. And my rough rule of thumb is a 1% increase in US tariffs in the average effective rate equates to an approximate 0.1% increase in CPI as a one-off price adjustment. But we also know, of course, that it takes time to filter through the economy, because, of course, we know the importer, the company that is importing those goods from overseas, pays a tariff on their entry into the United States. So the first payment is by the company, the importer, and then, of course, they send their money, their tax, their tariff off to the US government, which makes Donald Trump very happy. And then it's up to the company as to whether or not to absorb that tariff, that tax, in their profit margins or pass it directly onto the consumer. Every company, every importer is going to be somewhat different. So again, we don't know if it's certainly not a one-for-one. It's going to be somewhat diluted. Some analysts are suggesting 50 to 60% of the tariffs will be passed on to consumers. We just don't really know. But what we do know is that we're in the early innings, the early stages of the impact on final consumer prices. Because don't forget, consumer price inflation is a measurement for the average change in prices in the average shopping basket of goods that the US consumer buys. We saw last week, you will have seen, and I wrote about it in my weekly pain report, we saw a very sharp rise in producer prices of 0.9% month on month. And that is beginning to let us know that there are some pressures percolating in the plumbing of the inflationary system. My best guesstimate is that we will see consumer price inflation rise towards 4% by the end of 2025. We are nowhere near the full impact of these tariffs, because don't forget, Eugene, since April the 2nd, they've been on again, off again, on again, off again. We had huge pauses. Plus also, we haven't got certainty about some of the sectoral sectoral tariffs on, for example, pharmaceuticals. A lot of pharmaceuticals are imported into the United States. Then there's the semiconductor one. And of course, there's a lot of exemptions there as well. Then we've got steel and aluminium that are already in place. Then we had all the auto tariffs on South Korea and Japan, so on and so forth, and on the EU. The bottom line is this takes time to feed through the plumbing of US inflation. My best guesstimate, as I just said, heading towards 4% US CPI by year end.
That's quite a big number from where we are, what, at about 2.7-ish at the
Correct.
moment. So that would be a significant increase. And to give some perspective on that, if I could have an analogy of a supermarket, as soon as the tariffs go into play, well, the supermarket shelves are already stocked and those goods have already been paid for. So the tariffs don't flow into that. They flow into the goods that are still yet to be imported into the country. And that's why it can take up to several months, depending on how well stocked the different types of inventories are.
You hit upon an absolutely critical factor that I should have referenced. Absolutely right. We know that companies across the United States bought a huge amount of goods to front run the impact of the tariff. So the inventories went up extremely sharply. We know that from the import data in the first quarter in particular. And so, as you say, the warehouses were stacked full of goods that were pre-tariff goods. You have to work down those goods in the warehouses, work down those inventories. And then, as you say, it's when companies and retailers restock their warehouses with goods and the shopping shelves that will then start seeing the price impact of these tariffs. You're absolutely right.
So it'll probably be sort of end of the year, maybe even early next year when we see the full impact of everything that's been passed on. And the market will essentially decide in the different sectors how much of it gets passed on and how much of it's absorbed by companies. All right. So that's interesting. So moving on to like the impact to the economy and markets and whatnot. So inflation numbers have remained relatively stable, but as we've just discussed, we expect inflation to accelerate a bit towards the end of this year and early 2026. So what are your thoughts regarding the outlook for the US, including interest rates? Because obviously this has an impact on interest rates, considering the softening labor market and the wait and see regarding how the US economy will absorb tariff pressures.
Yeah. So this is where it gets what I've described in my recent reports as fiendishly complex. The macro environment is fiendishly complex. And it's complex because we've got a really interesting US economy at the moment. There is undeniable weakness in the labor market. And we saw that in the recent non-farm payroll report, where we saw those dramatic downward revisions to the last 2 months. And don't forget that in 23 into 24, we've seen 818,000 jobs being revised away by the BLS in 2024. So the backdrop for the employment market is much weaker than the headline numbers had previously suggested. So we've got general weakness in the employment market, and it's best characterized as following. Companies aren't laying people off as such yet, but they're certainly not hiring. And so we're in this kind of, calm before the storm on the employment front. The other aspect to the economy, which is I think noteworthy, and you and I haven't had a conversation about housing for a very, very long time in the United States. And we all remember, of course, with horror, the 2007-2008 backdrop to housing. And obviously, we're not close to that. But let's at least acknowledge that the US housing market at the moment in the United States is pretty much in hibernation, almost in deep freeze mode. All of the indicators, housing starts, existing home sales, new home sales, and the home building index, all of these are right at their 2009 or near their 2009 lows. So that's the housing sector. Very, very, very poor levels of activity. We go to manufacturing. Well, we know the evidence is there. The manufacturing is in the doldrums. Then let's go to the consumer. Now, the consumer is nearly 70% of the US economy. So if you're looking at your GDP jigsaw puzzle in America, the consumer is the lion's share of it. Over 2/3 of growth in the United States is generated by the shop till you drop US consumer. What's happening there? Well, real growth in the first half, around 1%. That's somewhat anemic. The CapEx spending related to AI, that is AI infrastructure, data centers, and all affiliated AI spending, the contribution from AI CapEx is now very similar to the contribution from consumer spending to US GDP. This is staggering. So I believe that the US economy is now very much like an economic engine firing on just one cylinder, that one cylinder being AI infrastructure and data center related spending. And I think that's really fascinating. So all in all, you've got a relatively anemic macroeconomic backdrop in the United States. So Powell and the FOMC are obviously looking at that aspect. And then, of course, they're seeing some of this inflationary pressure. And the jury is still out amongst most analysts as to what the inflationary impact will be. I've already put my cards on the table, and I think CPI heads up towards 4% by the end of the year. And you would probably describe that as being a kind of stagflation light. No radical stagflation, but it's certainly relatively anemic growth accompanied by some upward pressure on inflation. What does the Fed do? Well, Eugene, we know what the president wants the Fed chair to do.
Yeah.
And I think, at the September meeting, they will cut. I think they will cut by 25 basis points. But I think Powell is going to be insisting upon being data dependent. And don't forget, the end of this week, we have the all-important Jackson Hole Economic Symposium in Wyoming. And Jerome Powell will hopefully unveil to us his kind of roadmap moving forward, and how he sees the balance between the employment mandate and the inflation mandate. And it's going to be a very interesting Jackson Hole. It will be the last Jackson Hole meeting for Jerome Powell, because of course he will be replaced in May of 2026. And as you know, we're all trying to find out who he's going to be replaced by. But at the end of the day, the Fed from now on, from the next meeting in September all the way to May, is going to be a more divided Fed. We're going to see more dissents. Powell can pride himself of being very much a consensus-driven decision maker, but we're going to see a lot more dissents. And as a consequence, I think the FOMC meetings moving ahead will engender a somewhat higher level of volatility than we've seen in the last several years.
Is it fair to say that the Fed has laid off from cutting rates because of the uncertainty to inflation and economic activity due to tariffs? And so now that we sort of have some certainty around what the tariff situation is going to look like, I'm surprised that he's likely to cut in September. One would think that we're going to wait and see, given that a lot of it hasn't flowed through. But on the same token, there was a much larger number of rate cuts expected for this year that hasn't happened. So, because I think the obvious question is that Powell and the others will be asking themselves is, do we really want to be in a position where we have to raise rates because we get a bit of a spike in inflation? Hence the reason that they've not been cutting as aggressively as perhaps expected even 6 months ago.
Yeah, I think that's a fair characterization of the balance of risks and the decision-making process, because on the one hand, we've just seen evidence that the employment market, the labor market, is much weaker than had previously been advertised or represented. So that's a new piece of information. And if the Fed is data dependent, and don't forget employment is one half of the mandate, then clearly the FOMC has to give some attention to that clear and evident weakening. But on the other side of the mandate, you've got this slight upward pressure on inflation, but we still have an element of ambiguity as to the quantum, the scale of the pass-through. We know pretty much now what the tariffs are going to be. We just don't know how much of the tariffs will be absorbed in the profit margins by companies and how much they'll pass on to consumers. And that very critical information, we are going to be very much data dependent on a monthly basis as we roll forward.